Hi, everyone. Thanks for joining Jeff and I today. Can you believe this weather? Finally, the heat is on. Are
Oh,
you
you're
enjoying it, Jeff?
you're enjoying this? This is
I
awesome.
like I like the heat, but I'm not outside working in it every day or gardening every day, so I actually enjoy it.
Well, I hate it, and I'm
Hmm.
staying inside as long as I can. It says on my computer, my area is in a heat under a heat alert until 9:30 p.m. So
Yeah,
what can you do, right? But it's
right.
most of the Northeast that's getting this. It's not. I think I saw this morning that 30 U.S. states will be under a heat advisory this weekend.
Right. And I think Europe got hit with a heat wave,
Yep.
incredible heat wave,
Yeah,
a
Europe's getting
couple
hit
weeks
too.
back.
Yeah, I was
Hmm.
reading this morning that the that China makes 40% of the air conditioners, and most European residences don't have an air conditioner, so they're having
Hmm.
to go to the Chinese for some AC. But yeah, it's a global issue right now, isn't it?
Yeah, yeah. So today we're going to talk about there's the anticipation of a rate hike coming up this September. So interest rates are might be uh, inclining. So that's going to the market. I think they already factor in the anticipation prior to, right? If it's a gradual change, and they were, stating right now they're stating what about 52% of that rate hike happening at a
Yeah.
quarter percent.
Yeah, those are the odds in the prediction market that there's one rate hike in September for 0.25%.
Hmm.
And we should also say that we're just talking about the US here, but the US has so much influence on us, that's why we look at it. Um, so the market is expecting one rate hike in September, and then they'll do nothing for a whole year. So we wanted to go back and look at data to see how does the market react when there's you know one rate hike and then nothing thereafter. You don't have many examples of that because usually the Fed will raise rates or cut rates over a prolonged period, sometimes several years. And
Hmm.
so I'm sure you're familiar with the line that bull markets uh, don't die of old age, it's central bankers that kill them. Well, based on our analysis of these numbers, that's not true. The market uh, tends to shrug off rate hike cycles. It just depends on how quickly the central banks apply
Right,
them.
right. Which is interesting too, because you look at the whether it's an aggressive rate hike or passive, a gradual rate hike will determine how investors react, how the market reacts as a whole.
Yeah. So let me just throw some numbers at you. So as I say, we went back 40 years, and what we did was if it was a rate hiking cycle, we just looked at how the market reacted to the first rate hike. Okay.
Hmm.
And here's what the numbers said. So when there's an initial hike, the S&P 500 was down 4 percentage points 3 months after the hike. But then
Hmm.
if you extend that to 6 months after the hike, the market had recovered those losses and was now up 3% above the point at which the Fed made that first hike. And then if you
Hmm.
extend that to a full 12 months, the market is historically up around 7% afterwards. So that shows you that sell offs caused by rate hikes are short term in nature, and that if you just ride it out, you will see gains um, in a not so distant period. And those numbers I just quoted are the median when you look back over those 40 years. So
Right.
I think that's fairly encouraging. But why don't we talk about two specific examples where
Yeah.
the market reacted really differently to a rate hiking cycle?
Yeah. So there was 2004 to 2006, which is considered a gradual rate hike. There was 17 consecutive rate hikes of quarter percent.
Yeah.
And stocks, I guess, finished higher maybe a year later.
No, it was
So,
every year. It was every year.
okay. Okay.
2004,
So
5,
on average, okay,
yeah. But I mean, it's
better.
amazing because they raised hikes at every meeting, as you say, by
Hmm.
25 basis points, but the market was up 2004, 2005, and 2006.
Yeah.
So,
Whereas
no, you go ahead.
more aggressively, you can go through it 22 to 23 that we, just saw.
Yeah, that was the opposite effect. So there was
Hmm.
runaway inflation because they should have raised rates earlier, but they didn't. And then inflation climbed to almost 9%, I think, at its peak. Jay Powell and the Fed raised rates by a total of 5.25% over 16 months. There were four meetings where they raised rates by 0.75%, which
Hmm.
is triple what Alan Greenspan did
That's
in your
aggressive.
example.
Hmm.
So, and those four meetings where they went up by 0.75%, they were bookended by two meetings that went up by 0.5%.
Yeah.
So the market was down double digits in 2022 when they did that because they did it fast and they did it aggressively. But then
Hmm.
2023, we made it all back. So it was a great rally. And it's been a strong rally ever since. So I think if you compare those two examples, what you would conclude is that if a central bank raises rates predictably and slowly, the market will digest it and it won't create a sell-off, provided you know the environment is good, good economy, good corporate earnings, etc.
Right.
But if they do it quickly, unexpectedly, and they raise aggressively, the market does not like that. And you'll see a sell off, as we did in 2022. So the situation we're in right now is the market is expecting one rate hike of 0.25% in September, and then that's it
Mm.
for a whole year.
Yeah.
Um, but even that's not for sure because when we wrote this blog, it was yesterday, and it was 62% odds that they'd hike. And then this morning we got a jobs number for May, which wasn't as strong as economists expected. So now those odds dropped to 52%. So if you get another negative data point, you might not even see a hike. But let's just assume
Right.
you get a hike in September of 0.25%. I think it's a good buying opportunity because the history
Hmm.
suggests that these losses are very short lived. And just a few months after there's a hike, you see positive returns again.
Right. So investors should stay put and remain invested
Yeah, I
rather
mean
than panicking.
most of our stocks pay dividends, so all of our clients always have a little bit of cash. And if we see any weakness in September, we'll put all that cash to work, and it'll prove to be a good buying opportunity.
Yeah.
So
Right.
so
So we
we'll
shall
keep,
see.
yeah, we shall keep an eye on it. So stay
Okay.
stay cool in the in this heat, Sonny. I'm staying inside.
Yeah.
Okay,
All
all right.
right. Thanks,
Thanks.
Jeff.